Good morning to everyone. So, for our today's lecture, I'd like to wait a bit for the rest of the group because we will start with basic notion of stochastic calculus right from the beginning of the lecture. So I just hope that probably some more students would probably join us today. So let's just wait till 9:40 for the rest to come, and let's start at 9:40. So I believe it's time to start. So today we're going to talk about stochastic processes. This is the basic notion when it comes to derivatives pricing. All what we have discussed before were mostly a game of various notions, and I didn't provide you with any rigorous foundation for formulas for pricing logic. So there are two types of stochastic processes, in fact. We can talk about discrete time stochastic processes, and we can talk about continuous time stochastic processes. If we were on any financial engineering course, any financial engineering master's program, in this case, we would have three different courses: derivatives markets or markets, discrete time stochastic processes, and continuous time stochastic processes. Here we've got all in one, three different topics in one pretty short course. So while discrete time stochastic processes, when we consider a discrete time, we mostly focus on building interest rate trees in practice, so what we have discussed during our previous lecture is used in practice. Binomial trees are used in practice. They're used to build interest rate trees. They're used to price derivatives when we talk about numerical methods. So today we're going to focus on another approach that is more common in theory. So when we work with software, we mostly have a binomial tree inside. When we talk about any pricing methodologies and so on, there is a continuous time stochastic process that underlies methodology and theory and so on. So start with, we should consider stock price change. So we believe that a stock does not remember itself. The probability distribution of the price at any particular time in future has no dependency on its particular path. So we don't think about the path. How did this stock get to a particular point? This property is called the Markov property. And when we talk about the Markov property, we consider that a weak form of market efficiency takes place. So I hope you do remember what efficient markets, how efficient markets are defined. So in stochastic calculus, we introduce several forms of market efficiency: strong efficiency, weak, and so on. So here we won't talk about any formal side. We just noticed that the present price of a stock depends on the info contained in a record of past prices. So markets are competitive, and this competition ensures our set's weak form of market efficiency holds. So market participants follow markets, watch prices, and they are trying to make profit out of their trading activity. So if a stock is undervalued for short period in time, market participants tend to purchase an undervalued stock, and we believe that everyone has the same range of methods to assess the stock price. So when the stock price is overvalued, it's a common knowledge that makes market participants to sell the stock. So this is a very basic introduction of weak form of market efficiency. So we can all price stocks, and all methodologies are available, and all the knowledge about the stock and about the company is available, and we can use it to price a stock and make our investment decision. That's what a weak form of market efficiency is. So I'd like to introduce a very important notion in derivatives pricing, in financial engineering, Wiener prices. We have, I have already mentioned this type of prices during our last lecture. So there is a formal introduction and a mathematical introduction of the Wiener process. Here I provide you with a less formalized definition. So market property is when stock price increments are independent. Price today minus price yesterday is an increment. All these increments are independent. It has a mean that equals to 0, and its standard deviation equals to 1. This is a very basic definition of what market property is. So the change in value in n consequent years is the sum of normal distributions we believe that the process is marked, that the process has a Markovian property. That's how it is called. And these every two selected distributions are independent. That is why normal distributions are independent. So as far as you know, variance is equals to sigma squared. So if we sum two probability distributions, in this case, we can say that the sum of their means equals to their resulting mean, and the sum of their variances is their resulting variance. So the mean of the change during n years is 0, because we just summarize zeros, and the variance of this change is sigma squared multiplied by n, as we consider the resulting variance as the sum of variances, and equals to n, as sigma is 1. So here we've got resulting formulas. So once again, in mathematics, we have such process as Wiener process. This particular process is defined as a process with the starting point is 0. So this point starts from 0. It doesn't have any starting point. It has independent increments. So if we take two random consequent values, today's and that's one we had yesterday, or a value on the 1st of March and the value on the 2nd of March. So any two consequent increments the increment is independent of the past values. These increments, what is important, these increments, not values, increments, are normally distributed. And this process, a Wiener process, is what we use to describe the behavior of a stock price. So if we dive deeply into mathematics, there are lots of other properties and details, but it's out of the scope of our course. So what is the most important? 0 mean the process does not remember itself, increments are independent, standard deviation in our case is equals to 1. In fact, it is in general, it is constant, but it's more common to consider that the standard deviation and the variance are both equal to 1. So now we know a process that underlies a stock price movement. Okay, now we know how a stock price moves. Let's go further. So Wiener process properties that change during a small period of time, that what is an increment, follows a normal distribution. And if we talk about the stock price, the values for any two different short time intervals are independent. So it's very important to note that when we talk about increments, delta t, or time difference, is often considered small. But in fact, in a definition, there is nothing about how small these two consequent moves can be. Just in finance, we believe that these moves, we talk about daily stock prices in the majority of models. So in our case, there might be that delta t is equals to 1 day, but there can be any delta t, like 1 hour, 1 minute, and so on. It depends on your goals. If you are in algo trading, for example, in your world, delta t is like fractions of a minute. If we talk about like building interest rate trees, for example, and pricing securities, like what I do, I talk about days. In my case, delta t is 1 day. So If we have properties that's linked to a size of a movement, we have to note that the size delta t is proportional to square root of delta t, and square root is always bigger than delta t. So why do we need it? You will see later. Why do I focus on delta t? Because first of all, it comes from this part. So it mostly have a nature that's linked to variance, but we won't focus on it. So just this, what we have, Wiener process properties, point 1, is what you have to take like an axiom, but it can prove it. So what we need is that delta z is proportional to square root from delta t, and when t and delta t is always smaller than its squared root, so while delta t is small, square root is bigger. So now we know that the stock price movement, the change in price, can be proportional to this. That's epsilon is a random drawing from a standardized normal distribution. So epsilon is something random, delta t is time, and delta z is the change. So that's how delta z, or difference in asset prices, can be described. There is a stochastic term, epsilon, multiplied by square root. So to derive basic formulas, basic equations, we have to move the generalized Wiener process. So generalized Wiener process can be described as follows, and I will explain this part. So if we have a stochastic process, it is possible that the process itself has a drift and a stochastic term. A drift is something that is a deterministic function. A drift is an upward movement or downward movement. So it is something that was absorbed during some period of time, and it is something deterministic that is attached to a particular asset, and jointly with this property, there is a stochastic term. So there is a random movement. So while the drift rate measures an average change in expected value of a considered variable, the variance rate, or a stochastic term, measures the frequency of change of a variance in a time interval. So if we say that the drift rate equals to 0, by saying this, we imply that expected value of Z, asset price, or any variable at any point of time in future is equal to its current value. What is important? Expected value.
So we cannot say that the value that we observe today is equals to the value that we will observe tomorrow. We have no idea of what exact value we're gonna see tomorrow. But we know that an expected value, what we expect today, is the same thing as what we expect tomorrow. If you're interested in like going deep, you can Google for what is called the martingale property and dive deeply into specific terms. Is Z our process? Well, Z is our process, in fact. Z is what, look, I will explain this part, like X is our process, while Z is its stochastic component. So just give me a second. And what we are talking about is called martingale property. So it's outside the scope of our course, but you can have a look at it. So delta Z or Z part, what we have here is a stochastic part or a Wiener part or a Markovian part, but mostly it's called a stochastic term. This is what we have because we believe that the stock price moves like a Brownian particle. It has a part of its movement is explained through the Brownian motion. But the stock price itself is not a pure Brownian motion. It might have another component, and this component is called a drift rate, and this drift rate measures an average change in expected value. So if you have a look at any stock price chart, it can have a trend, upward movement or downward movement, or it can oscillate and remain at the same level. So if you see any asset that has expected price all the same, and its price chart looks like oscillations around a certain mean value, we can say that this particular stock, so we don't talk about any trend. The stock price moves up, the stock price moves down because of something. We just talk about an asset that has its price within a certain range. So, and we can say that to some extent, its movement can be explained by by Brownian motion, by a certain level of randomness daily values differ, but at the same time, its expected value. So we have a look at this oscillations around a mean. And now if we have a look at any stock price with an upward or downward trend, we can clearly see that its expected value differs. So if we can say an upward trend, it's obvious that tomorrow stock price expected value differs from an expected value that we had yesterday. It's an upward movement, so our yesterday's expected value was like 1.5. Our today's expected value is 1.7. Our tomorrow's expected value is like 1.9. So this trend is described with this component, and the stochastic part, randomness, is explained with this part. As far as you can see, here we've got dt. So if we omit the last part, we will have something that looks quite similar to a very basic differential equation. dx equals to a dt. A change in x that occurs with time is explained with a. So if we have this, only this equation, this solution gonna be x equals to at. So it is a straight line, upward slope or downward slope. So this is just a line. If we omit this part, that's a dt, we omit it, and we have only delta x dx is equal to b dz. This can be a stochastic differential equation only, and its solution is x equals to bz. While the first part is a straight line, this is fluctuations over around the mean. So the first term is a drift rate. The second term is called a stochastic term, a noise, a variability, and so on. So if we believe that we have our asset that is described with a Wiener process, and in fact, all equity-like securities prices are described with a Wiener process. I mean, equities, ETFs, and other equity-like traded assets that look like equity, shares in various exchange-traded funds, so on. So if we believe that we have a Wiener process, we can rewrite what we have here, and for a small time interval, we can have this. So data is something very small. Here we've got just small. So delta x is equal to a delta t plus b epsilon delta t squared, square root of delta t. Why do we have this epsilon and square root? We have it because we have it because we have introduced this. Stochastic term is described like this. And that is why we have, if we replace D with delta, we have delta Z here. We take delta Z from the previous slide, and we can receive what we've got here. So this is a very basic notion. Do you have any questions, or probably something remains unclear? So if so, don't hesitate to. So as far as I can see, everything is, I hope everything is clear. So a very simple example. Consider a company with a cash position that follows a generalized Feynman process with the drift of, with the following drift, $20,000 per year, and the variance rate of $900,000 per year. So if the initial cash position can be described as follows: $50,000 at the end of 6 months, if we believe that this company market position can be described with an equation given on the previous slides, we have to determine its standard deviation. And we can determine the cash position at the end of the year. The cash position is a random variable. We cannot be sure whether it reaches a certain value, but we can say that its expected value, its mean, equals to $70,000, and its standard deviation is equals to $13,000. So this is an interpretation of what is called the drift and what is called the variance rate. So the variance rate is a level of uncertainty, while the drift is something that is considered to be like for sure. Probably they have an operational model, and according to their operational model, they expect to have, let's say, a drift. The drift is positive, $20,000. So it might happen that this company has any operations and they expect the holdings to increase by this amount, while the variance is uncertainty. So this is what they expect by the end of the year. This is how a mean will increase, and this is the level of uncertainty. So look at this example, please, just in order to ensure that you understand the financial meaning of what a variance is when we talk about this composite process. So there's something that we know for sure, and this is something that's we believe we know for sure. And this is something, and there is something that's is considered to be a stochastic term, there's something unpredictable. In our case, their uncertainty equals to 30,000 of US dollars, and 70 is what they expect to have despite the uncertainty. This uncertainty can correct an overall value, because expected mean is not the same as received profit or something. So if you don't have any questions to this particular slides, we can move further. So we were talking about a Wiener process, and I used constant values here. A and P are constants, but in fact, why constants? It's a bit ridiculous. So I have a stock. I study financial statements. I study markets. I study everything, and I introduce a model to predict this particular company asset price. So it cannot be a constant. I take its operational model into account. I analyze its dividend payment history. I analyze its mergers, acquisitions, it's everything. So if I'm smart enough, I can introduce a nice model to predict this particular company stock price. This model is obviously something complex, something more complex than just a constant. And probably I will introduce a function. First, let's consider a simple function. So in my case, I probably conducted an analysis of prior stock prices. And I have a function of a stock price X and T. So I believe that my stock price depends on its value at some point in time, and it depends on time. So this is a deterministic part. At the same time, it's very probable that I would conduct an analysis to find out any law that its uncertainty might be subject to. So while this is a stock price analysis, and I try to find out a function, its trend, so I try to find a function that can describe this particular stock trend. And this B is a function that describes its level of uncertainty. And to get this function, to derive this function, I will obviously need to conduct some analysis that's based on econometrics and stochastic calculus. So I'm trying to find out the law that can be used to describe this part variance. So whether this particular stock will have a wide range of probable outcomes, whether its fluctuations are frequent or not frequent, what's the timing, and so on. So this is, I analyze the stock price and derive a trend. And here is, I use some GARCH or any variations of GARCH like TARS or anything. So I use any of family of ARCH models to find out any additional info to contribute to this tour, and I've got a function. So I'm happy. I have a nice couple of functions that helps me to predict the stock I watch, the stock I trade. So what should I do with my findings? What should I do with my nice models? How can I apply them to pricing? Let's get back to our process with constants. So we're not going to forget about this, a realistic case, but from now we have no idea of what to do with this. So let's make an approach that can be derived from solving this equation, and it might be probably suitable to solve this one, to apply this one to pricing. So now we have generalized Weiner process once again. So what is the idea? I watch a stock. I analyze this particular stock behavior. I do some statistical tests. I read statements and so on. Now I know several laws that can be applicable, or I believe can be applicable to the particular stock. I would like to make a trading strategy, or I would like to price a derivative that has this particular stock as an underlying. So the simplest question is, if I'd like to build a structured product, if I'd like to have 4 different equities as underlyings for this structured product, and I have different laws for all these equities, how can I price this structured product? What is the price of the structured product? How can I derive it? Or if I have I would like to introduce a barrier option or a look back option or any path dependent option, and we're going to talk about these contracts later. So how can I find its price? I have a stock. I know that I can issue an option, or I can issue some structured products, but I have to know its price. What's the price of the product that is linked to this particular security? That's a little bit difficult to answer from now, and we're trying to find an acceptable way how to calculate this price. So we get back to a generalized Weiner process as a proxy to our models. So this generalized Weiner process does not fit me because it fails to capture time dependencies. It fails to capture the expected return. So what am I supposed to do? I can notice that the constant expected drift rate needs to be replaced by an assumption that the expected return is constant. Why am I talking about the expected return? If I have any structured product, if I have any trading strategy, what is important to my investors? What is important to my clients? They won't talk with me in terms of drift rates. They won't talk with me in terms of volatility and so on. If I'd like to introduce the product, first of all, I have to announce its expected return. that is what is important in investments. And these drift terms, variances and range and so on, they are important. They are important to risk managers, they are important to product controls and so on. So I don't omit an importance of these values, but the expected return is what goes first. So let's try to work with our basic letters, basic notations. So if S is the stock price at time t, the expected drift rate can be denoted with mu S, where mu is the expected rate of return on the stock. And if we consider a short interval of time, the expected increase in S is mu S multiplied by delta t. I hope this is clear. So if volatility is equal to 0, we believe that this stochastic term is 0. And in this case, we have a very simple differential equation. That's something that you know how to solve. You just integrate both parts, integral here and integral here, and you got S. If we consider a period of time from 0 to capital T, you have an integral from 0 to capital T here, the same integral from 0 to capital T here. You integrate both parts from 0 to T, and here you've got S sub capital T, a stock price at time T, and here you've got and here you've got the part for how this part is been described, like a stock price evolution. So this is the stock price evolution. This is what we've got. Yeah. So I hope you do remember that if we have S here, before integrating, we have to divide this equation by S, and you will get in details here, ds divided by S equals to mu t. So while you integrate this, you will get a logarithm, and after you get a logarithm, you convert a logarithm into an exponent, and that is how we get this. So I hope that this is clear and you don't have like any, how did we get from this point to that point? If you have any questions, like how did you receive it, send me a message in Telegram, please. I'll just get back to you with how. So now we know how the stock evolution can be described with the equation if the stochastic term is omitted. Perfect. What about the stochastic term? If we introduce a stochastic term here, we should give an economic sense or financial sense to this stochastic term. So if we assume that the variability of the percent return is the same regardless of the stock price. We can conclude that the standard deviation of a change in a short period of time should be proportional to the stock price, and the volatility of the stock price is constant. So here on this slide, you can say the most common form for stock price evolution. What is important? DT is deterministic part. This is what happens as time passes by. DZ is a stochastic component. Z is a stochastic process. To deal with stochastic differential equations, you obviously need to read some additional math books. We are not going to dive deeply into this stochastic part, but as far as I know, you don't have this course. So what is the summary? This is a stochastic part. This is a Brownian motion, and you can visualize dt as a straight horizontal axis from 0 to t. As for dz, you can visualize this as a path that is made by a Brownian particle. It is a bit messy, but this visualization will help you to understand that you cannot treat this part using the same approach that you can treat this part. It has some different properties. So while you are studying in integrals and differential equations, you learn some properties. You learned how to find a mean, you learned how to find a solution, and so on. If we come to that point, if you'd like to deal with these things, you have to study an additional course to know how to deal with this part. It has some specific laws. They're not difficult, they're not something hard to study, but this is different from this. You cannot treat these things equally from mathematical standpoint. But for this course, this is not important. So you just follow these formulas that I provide you with. So sigma is the volatility of the stock price, and mu is the stock expected % rate of return. Perfect, rate of return. So now I can express watched stock behavior with a volatility or riskiness or randomness part, this part, and I have a return part. This is beta. So I can talk with my prospect clients, with a product committee or whoever, using a very clear notion of return. This return, this uncertainty. A return and uncertainty. Return and risk. Perfect. So let's move further. Here on this slide, I'm trying to introduce a very basic notion. This notion is from a stochastic, continuous time stochastic processes. But at the same time, we have the same lemma introduced in basic derivatives books. And this is why you have this lemma here in this course. What it is all about. We have already introduced a process. So we have something, the X. It must be a stock price or any other parameter, so any variable. We know that this variable can be described with this equation. Our studies led us to this equation. So this is how we can describe it. That has a constant, it has a deterministic part, a function, so a trend, upward, downward, a function, whatever. And here we've got a stochastic part. Okay, we know that DZ is a Wiener process. So if we talk about stock prices, we don't have to prove that DZ is a Wiener process, as it is a common knowledge. Like if we talk about a stock, we can describe it like this. So you don't have to prove that DZ is a Wiener process if you build a model for any stock. As for any other process, in social studies, in macroeconomics, whatever, you can introduce the same equation, but you have to prove that there is this Wiener process inside. We don't prove anything for stock. For us, it's an axiom. It is not an axiom, in fact, but we can use it as an axiom. Okay. The process and the Wiener. Ito's lemma shows us that a function that depends on this variable follows the described process. How can I apply this lemma to pricing? As soon as I know that I have an instrument and my instrument payoff depends on a stock price, this grain X here. So I have an instrument, its price depends on X. I can use this formula to derive how the payoff, for example, of my structured product evolves over time. If I build a complex structured product and I have one stock inside, my structured product payoff, so I introduce a function for my payoff, and I've got stock price inside, and I've got time t. I can say that my payoff evolves according to this equation. How do we get this? What's this? So for those of you who have a mathematical background, this green part might resemble something from the Taylor's decomposition. So you have partial derivatives here, first order. It's a partial derivative of second order. And this is true. To derive Ito's lemma, we use this simple Taylor's decomposition. You can find details for this in various sources. So how do we use this lemma? We use it to derive various payoffs. So it's a very common thing. Like, I know that I have a stochastic process. I'm given a stochastic process. I derive a stochastic process myself. What about the payoff? This is what I have for the payoff. So all these terms in this equation have their proper sense. The orange part, you can see dt here. So the orange part is a drift rate. The red part is a square root of variance, a stochastic term. This is the same Wiener process. What is important? If I have uncertainty that influences my stock, I have the same uncertainty that influences the product I create using this stock, the same uncertainty. What is the most important property? If I have a certain level of uncertainty as an input, I will have the same level of uncertainty as an output. So by creating a product out of a stock, we cannot decrease or increase a level of uncertainty. It will remain the same. The level of uncertainty is a level of risk. So by creating a single product out of a stock, by just decomposing it, I cannot manage the risk attained. And I can manage risk if I add various stocks. This for sure, we have Ito's lemma for the case of several variables for a product that is built out of several stocks. Formulas are out of the scope, but if you build a product out of several stocks, you can have your level of risk sometimes balanced. So it depends. So you need to work with this type of equation. So to summarize, if I have a stock, if I describe the stock behavior with a process, I can create various products which payoffs depend on this particular stock behavior. And I have a nice tool that is provided by Ito's lemma that I can describe my instrument evolution with information that I've got from my stock analysis. So I hope that this is clear. So Ito's lemma is a very basic thing. And you just have to keep it in mind if you ever decide to pass any derivatives linked interview. It's a very common thing. So how can we apply Ito's lemma to derivatives pricing? So here I provide an example. Let's consider an equity forward price. So at the beginning of the course, I was given a question about how do we know the price of a forward contract? So I gave you this I gave you this equation, and I told you that we cannot reach an exact formula. Just wait till the end of the course. We are nearly at the end of the course. So what do we have here? This is a forward price. The basic instruments which pay off depend on underlying asset, underlying stock. So what do I have? I have this etho lemma, but instead of J, an unnamed function, I have a very nice one, F. So I replace J with F. What do I have to do to get a final stochastic differential equation? So first I have to calculate the first order partial derivative, df ds. This is what I get. What should I do next? First order partial derivative, dt. Here it is. This is the first order partial derivative. And now I have to calculate the second order derivative. Here it is. I've got also b squared in Etho's lemma. How do I get b? Well, for a stock price movement, a deterministic part, in our case, equals to mu s, because this is how my asset behaves. This is my asset behavior. And B is sigma S. This is a basic form. This is a basic stochastic differential equation that describes the stock price evolution. But in fact, I can update it to in any form to add something, and these things will change. But if I'm not too deep in mathematics and I'm pretty satisfied with what I've got here, I replace b squared with this, with sigma s. What about a? Here I've got a, and I replace a with mu s. And this is mu s, a replaced with mu s. This is sigma s squared because I've got b squared. So what's the result of my calculations? df equals to, I just use these partial derivatives and coefficients and everything. So, and this is how my forward price will evolve over time if I believe that the stock price evolves according to this equation. So this is the stock price evolution, and this is a corresponding forward price evolution. Before we introduce this apparatus, every time we need to find out a forward price, we had to have a look at the stock price, calculate the time, and multiply by R. So I can, if I don't know this, if I don't have this, I can calculate forward price at any point in time, but I have no idea of what my forward price can be in a week time or in 1 month time. I'm like a blind person who can see something, only when this is just put in front of this person's eyes. And this provides us an ability to look forward, to predict. So there is a certain competition, because if you and I, and if every one of our group and I will conduct the particular stock analysis, it might happen that we will obtain different mu, and we will obtain different sigmas. I took like 3 years period analysis to derive sigma. One of you took 10 years, another person took 1 year. So this is the timing. It is possible that you, as soon as you get the stock price data, you clear the stock price data from outliers or from any periods that you believe are inappropriate. I will take closing prices, daily closing prices. You will consider all intraday prices, for example, and this is how we will obtain different values. So now have a look at this part. Do you know why do we consider a logarithm? What for do we need a logarithm? Who knows what for do we need a logarithm? That's a pretty correct answer in the chat. So we mostly deal with logarithm because, first of all, logarithm is positive. Second, logarithm of s divided, if I divide today's stock price by yesterday's stock price, and I take a logarithm out of this, I will get a % return. So just give me a second, I'm typing. Give me 1 second, please. I've got a barking catastrophe. There's something interrupts my dog morning. I'm sorry. Sorry, I'm back again, because when my dog starts barking, it's really difficult to continue. So what I typed in chat is that's how we calculate a return. And we use a logarithm of price in many other cases. So it might be useful to repeat the same thing using a logarithm. We do the same logic as we did on the previous slide. The same partial derivatives, replacing a, replacing base, and here is b squared. And what we've got here, if we calculate those partial derivatives accurately, if we replace everything, we will get this, a very neat and simple form. A very neat and simple form. But in fact, this resembles us a generalized Wiener process, as mu and sigma are constant. So what we've got here in parentheses is constant, is like a new A, and sigma is a new B. So we started with a process, we considered logarithm, and we received generalized Wiener process. Right, that looks absolutely the same, A and B. And here we've got the same. So what is important? We will just finish with this block and you will have a break, because I like to get to the final thought. If we talk about a generalized Wiener process, we have noted at the beginning of the lecture that a variable that is described with a generalized Wiener process is distributed normally so the logic. There is a Markov property of a process. We have Wiener processes with a Markov property. One of the most important properties of a process that is called a generalized Wiener process is that if a variable can be described with a generalized Wiener process, this variable is distributed normally. So the change in logarithm of price between time zero and some point in time t is normally distributed. This is what we've got. So a logarithm of something is normally distributed. Okay, if the logarithm of something is normally distributed, what about the distribution of something? So I hope you catch the idea. I introduced a process, logarithm of s. I derived that this particular process can be described with a generalized Wiener process. Great. Okay, a variable, and I found out that this variable is normally distributed because it can be described with a generalized Wiener process. So what? So if a variable is, if a logarithm of a variable has a normal distribution, a variable has a log normal distribution. You can prove it if you'd like to, but today you have to trust me that this is true. This is the truth. So a variable has a log normal distribution if the natural logarithm of a variable is normally distributed. So the summary. We observed stock prices. Wow, stock prices differ. Good. How can we describe what we can say? We open a book on math. We find a Venn process here. We compare, we try to use it, and we say to ourselves like, okay, this is a nice mathematical formula. I'd love to use it. A nice one, a simple one, and it looks like it can explain what I see. But if I deal with any variable, well, if I deal with anything, I'd like to know how this variable values are distributed. The distribution gives us an answer to the question, what is the probability of? If I deal with any stock, it's very important for me to know what is the probability of this stock price remain within a certain interval. What is the probability of this stock price increase up to, and so on. So probabilities are important to me if I like to trade this stock or if I'd like to build structured products linked to this stock. But I have no answer to any question that is related to a probable outcome of my product or my strategy if I don't have any distribution. And I try to find distribution, and luckily, that's not luckily, but I found out that a logarithm of my price of the asset I'm interested in has a log normal distribution. This is great, what I can say to myself, but great that I know a distribution since now. Its logarithm has a normal distribution. It implies that the asset, the variable, has a log normal distribution. This is a log normal distribution. This screenshot from a book. So now it is time to have a short break, and we will continue in 10 minutes. This is a log normal distribution again. So we will continue with some log normal applications and examples. And that's okay to have a break now. The conclusion is we can have it after you get back from a break. So I hope you had a nice break, and we can continue with log normal distribution. So what is important, what you have to memorize if you ever been asked on an interview what the log normal distribution is used to, you have to remember that it goes to show that the probability distribution of the continuously compounded rate of return earned on a stock between time 0 and time t is normally distributed with mean that can be calculated from this particular stock mean and sigma, and with a certain standard deviation. So this is a key use, that is what we use the log normal distribution to show the rate of return, the continuously compounded rate of return, and the logarithm. So let's get back and have a look at something. So why logarithm? Logarithm because when we divide ds by s, we get logarithm here. And this is how we came to an idea. So this is a logarithm, right? If we integrate, we get a logarithm. And this is why we deal with this logarithm later. And this is why we have, so we introduce if we solve it, the logarithm of s will be on the left-hand side. So this is all in one. We use logarithm to talk about returns, and we have logarithm here because of this modal property. So we came to the same point, to the logarithm of price, from the financial point of view, because we are interested in returns when we talk about investment, but finance. And we came to the same point, we came to logarithm starting from math. So math and finance both led us to logarithm. That's why log normal distribution is mathematically approved. The use of the logarithm distribution is mathematically approved, and the use of this distribution is financially is logical and is logical from the financial standpoint. So please remember what is given on this slide. And I provide you with a very simple example to illustrate how can a log normal distribution be applied to financial case studies. So consider a stock with an initial price of $40 US, an expected return 16% per annum. How can we get an expected return? We can upload stock prices. We can apply any linear regression model. Expected return, what is an expected return? Well, if I believe that the stock price has no drift or has a linear drift, I use a simple least squared estimate. So I just opened a book on econometrics and I found out how to calculate an expected value of a variable. If I'm given a set of values, you can use Excel, you can use Python, and you can just, you get an expected return from the least squared estimate. For Russian-speaking students, least squared estimate is the same as МНК, метод наименьших квадратов, least squared estimates. So you get an expected return, you get a volatility from the same method. So you have these, so you uploaded prices, good. You applied least squared estimates, you received an expected return, you received volatility. Great. So what's next? You are interested in the probability of the stock price in 6 months' time. You can ask different questions. So now it's simple statistics starts. I hope you studied statistics and you do understand what I'm talking about. So this is a very simple thing. I calculate these values. So now I have to find out I open a very, so this can be found as calculated as CDF function, cumulative distribution function, or you can have a look at, you can have a look in a table to find out the value. So how do you get, this? So you have these values. So you open Excel or any statistical package or even tables printed on paper, and for 95% probability, this is a normal distribution. So this is a logarithm, and that's why this is a normal distribution. So you just open tables, you receive these values, you've got a logarithm within a certain range with 95% probability, and you receive these values. So this is a very simple example of how a 95% probability value can be received. This is arranged. This is what we have. So this is a very simple thing. If you'd like to, well, I will provide a Python example, how to deal with this, how to upload prices, how to calculate. It won't be a complete example, like it won't be like everything is done, but it will be like some basic steps. So let's move on. So the summary for this part. So this part was an introduction, a very basic overview of what is continuous time stochastic processes are. We know that Ito's lemma is a way how we can calculate a payoff, a process, something that uses a known function of a variable. So we know a stock, we derive an equation to describe our stock behavior. We found mu, we found variance, and after we find mu and variance, we can find a numerical explanation of our expectations. So we calculate what we expect from a product that is based on a particular stock. And we use Ito's lemma to find out the process, how to describe it, as you have seen with logarithm of S and with forward values. So in finance, the stochastic process is usually described with a geometric Brownian motion. So we believe that the return that any equity-like traded asset generates is normally distributed, and the price is log normally distributed. So, and we continue with the Black-Scholes model, and to derive this model, we use Ito's lemma and the geometric Brownian motion assumption. So as soon as I say no questions in chat, I hope we can proceed. So the Black-Scholes model. So all over the world, derivatives managers, structurers, quants, and other and all derivative public, all derivative stuff focus on Black-Scholes pricing model. I cite Vicky on the first slide. But what has happened to Myron Scholes and Robert C. Merton? What has happened to their investment management company that was called long-term capital management? So LTCM was a hedge fund that used absolute return trading strategies combined with high financial leverage. LTCM was founded in 1994 by John Mayweather, the former vice chairman and head of bond trading at Salomon Brothers. Members of LTCM's board of directors including Myron C. Scholes, Robert C. Merton, who shared the 1997 Nobel Prize in Economic Sciences for a new method to determine the value of derivatives, 1997. Initially successful, with annualized return of over 21% after phase in its first year, 43% in the second year, and 41% in the third. In 1998, it lost $4.6 billion in less than 4 months due to a combination of high leverage and exposure to the 1997 Asian financial crisis and 1998 Russian financial crisis. The master hedge fund, LTCM, collapsed in the late 90s, leading to an agreement on September 23, 1998, among 14 financial institutions for a $3.6 billion recapitalization under the supervision of the Fed. The fund liquidated and dissolved in early millennium. So even if you are a Nobel Prize winner, even if you work with one of the most influential investment banks, head of bond trading, even these aspects can be neglected by adverse price movements and by panic, because in fact, the pricing method that was used by Scholes and Merton is valid. Their method is still valid and is still accepted. But what has happened to their funds? Extreme panic and high leverage. So it's very important to bear in mind that even if you are smart, even if you have a support from talented managers, sometimes you cannot just deal with adverse price movements and, what is more important, with panic. So let's move. So the Black-Scholes model assumptions are the following. So I listed them from 1 to 7. So the stock price follows a known stochastic process, short selling of securities with full use of proceeds is permitted. We have discussed this on Monday. No transaction costs, no taxes, no frictions, no dividends as well, no riskless arbitrage. Security trading is continuous, and the risk-free rate of interest is constant. This is important because, in fact, the risk-free rate is not constant. It evolves over time. This is very important because, in fact, all these details seem to be tiny, but they have a significant effect on an overall price. And these details are used in various trading models, trading algorithms, and optimized trading. So as in big and professional sports, we don't compete for big wins. Our competition is a competition for like the third diet after zero, like fractions of a percent. So the Black-Scholes model applies the no arbitrage approach to a continuous time process. So to some extent, it is equivalent to a binomial model. The binomial model is a discrete time model. If we, in discrete time modeling, if we assume that the time step is nearly zero, we will get the same outcome as a continuous time process. So these two approaches, these two approaches are not opposite approaches. So the Black-Scholes model is also consistent with the basic statistical fact that the binomial process with a large number of steps converge to the standard normal distribution. That's how this property is explained in more smooth terms. How do we get the Black-Scholes model for stocks? Do you remember this? Right? Do you remember the ethos lemma? Do you remember how we replaced G with the payoff? Okay, so imagine that we have introduced a call option payoff and a put option payoff. I hope you do remember these simple formulas like a maxima or a minima of the difference between stock price and the strike price. So we did the same thing with this function with option payoff, and this is what we get. How do we arrive to n? And it denotes the cumulative probability distribution function for a standardized normal distribution. So how do we have this here? We have this here because standardized normal distribution is what we received previously for the stock price logarithm. How do we get this part? What's this? Time value of money. This is the strike price, and this is the time value of money. So we are not going to derive it. If you'd like to, I can provide you with some materials whether the Black-Scholes formula is properly derived, I mean, with all math and so on. So what is important to us? This, we achieved this from the stock price evolution. We applied Ito's lemma to the call and put option payoffs, and we received this. That's what we see. Do you see, for example, this part, sigma squared divided by 2, and sigma and square root of t. So all these things were mentioned in our previous slides, and I hope that these things looks quite natural. So as far as we understand, the Black-Scholes multimodal is a continuous time version of the discrete time binomial model. But what is important, we can use continuous or discrete compounding for the interest rate, or as for the volatility, it is expressed in annualized percentage terms. So these points are important when you'd like to calculate European call option payoff. And what is more important, volatility, you can introduce a specific distribution for volatility. You can introduce a specific equation for an interest rate and so on. So you can adjust this formula as you like. You can introduce lots of different terms and so on. So if you look for look-back options pricing, interest rate options pricing details, you will see that there is this Black-Scholes formula adjusted. So after the end of the lecture, I will show you some formulas, some adjustments, if you'd like to. So this is something that can be adjusted to various options types. So by default, the online is non-dividend paying stock, but you can adjust for any dividends, storage costs, for anything. As I've already told you, the N is a CDF, cumulative probability distribution function for a standardized normal distribution. So there's D1 and D2 as a range. So if we talk about N of D1 and N of D2, it means that we take a CDF of this number and this number. D1 and D2 are numbers as far as you can see. And so there is a function in Excel, there is a CDF function in Python, so you can calculate any option price just by using a simple formula in Excel, or so you can just use this formula. You can type it in Python or Excel and calculate the European call option price and put price and whatever. So this is what you take home. Have a look at this part after you, as soon as you start completing your home task. A reminder, I hope you do remember what the cumulative distribution function is and what the standard normal probability density function is. So this is like a flashback card. So so let's have a look. These are the Black-Scholes model for stocks. And Black-Scholes model, that call and put, can be described as the present value of the expected option payoff. I hope this is quite easy to understand. It's not like rocket science, that if the call price today is $1 US, it implies that the present value of the expected option payoff is $1 US. From the mathematical point of view, we can just find an expected value. And this is what we have here. And how do I get that the present value is this? I hope you do remember the discount factors and so on. So this is why we have this discount factor here. To bring any future value to the present, we have to multiply the future value by a discount factor. So this is how we can express the expected future cash flows in terms of the Black-Scholes formula. What is important? We omit any specific risk. We price assets from and we don't pay attention to accompany risk of default. When I talk about the stock price or when I talk about a bond, I don't pay any attention to a probability of a default of the counterparty or stock issuer, counterparty bond issuer, or a company that has issued stock we are dealing with. So from our standpoint now, all issuers are the same. But we know that, for example, purchasing Greece bonds or purchasing, for example, Norwegian bonds, different thing. We do not expect any default from Norway, but we expect to somehow that we cannot neglect the probability of default when we talk about Greece. If we talk, for example, about sovereign debt of Nigeria, that is a non-zero probability that Nigeria might default on its bonds despite undeveloped economy. So not all issuers, not all bond issuers are the same. We talk about stock, that's the same thing. Who would believe in a bankruptcy of Microsoft? But what about a bankruptcy of any automotive corporation while automotive industry is not on the top of the top right now. Well, we might believe that, for example, any car manufacturer might default. That's why not? It's probable. So if we don't have any idea of a risk inherent with a particular instrument, we say that we operate in a risk neutral world and we deal with a risk neutral probability. Remember this notion, please. And if you'd like to study the subject in details, you have to read about risk neutral measure, forward measure, and so on. So you can provide books, but it's very important to be able to interpret what is a risk neutral probability is. So the present value function is based on the risk-free interest rate, not on the investor's required return. This fact is important as well. So the required return in investment capital is a well-known measure by those of you who are involved in like a project management or investment products assessment and so on. So in various companies, the required return is different, and to different investors, the required return might differ greatly. So in these things are not weak points. These points are like something that you can improve with your own models. So Black-Scholes provides just a very basic set of formulas, and if you'd like to apply these formulas to your particular instruments, your assets, you have to find an adapted version that accounts for your specific needs. When we talk about these formulas, we can say that there's a stock component and a bond component. So the stock component is always this, the first part that is linked to a stock. This is a positive for a call option and negative for a put option. This is a bond component, negative for a call option and positive for a put option. If you derive carefully these formulas from an option payoff, I hope you do remember that the call price is the difference between the stock price and the strike. You have the opposite for the put option. And that's how deriving these formulas from an option payoff will lead us to this or this, the difference between this, the higher the stock price, the happier the long, and here the lower is the stock price, the happier the long is. So we can use the Black-Scholes model for a dynamically managed portfolio if we have a stock and a zero coupon bond. So I think that we have discussed these replication strategies. So I hope you can study this particular example on your own. This is the same replication strategy. We built a portfolio out of 2 instruments, an amount of stocks purchased, an amount of bond purchased, their prices. So, and now we replicate an option as an amount borrowed and a stock purchased. So this is the mechanics of this replication. So what is important? When we replicate this portfolio and we calculate the strategy cost, so I can purchase an option, or I can purchase stock, a number of stocks, and a number of bonds. So what is the equivalent number of underlying shares? What is the equivalent number of bonds? So how many bonds, how many stocks should I purchase to replicate a particular call option? You can say in yellow and green, and estimates for a number of assets to be purchased. So if we'd like to replicate a call, we purchase stock with borrowed money. That's why number of shares is greater than 0, and number of bonds is less than 0. That reflects borrowing. So this portfolio replicates the payoff of the call option, and it can be viewed as a leveraged position in the stock. For the put option, we do the opposite. So we purchase bonds, and that's why number of bonds is greater than 0. But to purchase bonds, we have to short sell the underlying, and that's why number of stock is less than 0. And this portfolio, when we short stock, long bond, the number of bonds purchased, the number of stock short sold, the number of bonds purchased can be defined as follows. So this portfolio replicates the payoff of the put option. So short position in a put results in receiving money today and can be viewed as an over leveraged position in the stock because the borrowing exceeds an overall cost of the underlying. So this material is something, I may not say that this is a unique, but this view, this interpretation of a portfolio is not very common. So just try to keep in mind that you have like stuff like this. An interpretation of the Black-Scholes formula of these numbers as an amount of bonds or stock to be purchased to replicate portfolio. So I see that there are no questions. Okay, so we can move forward. So if I know how to estimate a number of stock and bonds that can be purchased or sold, they can be long or short, I can apply the same model to the strategy. If an asset price increases, then the value of a stock component, this is a stock component, and also increases. Thus, the replicating strategy for calls requires continually buying shares in rising markets and selling shares in falling markets. This is a very basic thing, but this simple idea is sometimes used to hedge complex structured products. So my approach can be criticized, but sometimes if you issue a very complex product and you have to find any solution in a short period of time, and you can't afford yourself to wait till you derive model that completely covers your newly issued product, you can always rely on this simple dynamic hedging. This is a very simple thing. There are more complex dynamic hedging strategies, but if you have no idea of how to hedge, but you have to hedge it like right now, right here, you can always use this strategy. So you can replicate, you can back your position with a stock for a certain amount of stock. That's applicable to various like equity-linked structured products that are quite complex to model, and modeling of these products requires certain time and efforts. So within the Black-Scholes multimodal theory, the aggregate losses from this buy high, sell low strategy over the life of the option adds up exactly to the Black-Scholes multimodal option premium received for the option at inception. So this is why this strategy cannot be really profitable. So you just back to back, your position is backed, no interest. But however, this strategy taken standalone can be used, is called a scale trading. And this scale trading is a nice strategy that can be used in practice for long-term management of a portfolio of stock. So this is, so I mostly talk about things that that we do in some teams, at work, at some other teams that I do some consulting. So these are like real world use cases. This strategy can generate moderate profits. What is important, the market must be really liquid and active. Because if the market is inactive, illiquid, this strategy won't work. But this idea is mostly used for hedging equity-linked derivatives, because it's very difficult to hedge an equity-linked derivatives because there are no single name equity options, there are no single name equity futures, so you have only index. And as we discussed several lectures ago, you can hedge single stock performance with a number of futures contracts, index futures contracts, but you have to account for beta to be able to hedge any portfolio with index. And actually the risk of misstating the beta is really high. So long and short, the stock is about a strategy. To my extent, this strategy inherits a lower modal risk. Modal risk is the risk that the model is incorrect. But I apply to a real life case a model that cannot be applied to this particular case. So what about the practice? If you'd like to apply a Black-Scholes multimodal in practice, you have to account for transaction costs. You have to bear in mind that the frequent rebalancing of portfolio by buying and selling is expensive because you pay commission. You probably have to pass margin. That margin locks your funds. So some markets sometimes move discontinuously, contrary to the Black-Scholes model assumption. So what is important? What is important for any quant interview and for real life practice? If an observed stock, if a watched stock moves unexpectedly, today's price is 10. Tomorrow's price is 100. Or today's price is 5. Tomorrow's price is 55. Today's price is 200. Tomorrow's price is 2. Black-Scholes Merton model doesn't account for this drastic change. And all your models, all your monitors, or all your calcs will fail if a watched stock will experience such a movement. This movement is an outlier. A Black-Scholes multimodal cannot deal with these outliers. It implies that prices moves continuously at the same range, approximately the same range of volatility. So if a stock experiences a drastic move, nor your delta nor your gamma, the Greeks, and we're going to talk about Greeks in our last lecture next Saturday, won't show you, won't alert you. You don't have Black-Scholes Merton model related alerts to inform you about this, and you will lose money. And this is this thing had to be beared in mind. So if you face an outlier, if you face like a black swan, the Black-Scholes multimodal cannot predict you any black swan, any outlier. Just take it. So as for volatility, it cannot be known in advance. All we have is an implied volatility or historical volatility. We cannot foresee our future. We cannot foresee volatility. So, in fact, actual option price is higher than the price that's predicted by the Black-Scholes multimodal. So if you deal with any pricing, you have to account for these transactions, costs, taxes, for everything. That's why it is important. So this term, and from D sub 2, that's what can be seen with the bond component, has its own interpretation. So this term is a measure of the probability that the call option expires in the money, or it's a probability. If we talk about the put option, There's a probability that the put option expires in the money. So the probability based on the risk neutral probability of being in the money, it is not an estimate of the probability being in the money, nor the market's estimates. It's a risk neutral. All issuers are the same. All companies are the same. No risk, all is the same. And that's why this this assumption needs to be adjusted. What about the carry? The cost of carry or carry benefits? That's quite easy. We can just adjust the model. We can use gamma. We add it to a star component. We add it here and here. So this adjustment can be used for all instruments that can be regarded as instruments that pay you something. Coupon, foreign interest rate, or any carry benefit. So if you believe that an instrument pays you something, and this payment can be considered as a continuously compounded payment, you can adjust Black-Scholes formula with this term. So the existence of carry benefits has the effect of lowering D sub 1 and D sub 2, has the probability of being in the money with call options declines as the carry benefit rises. So just think about it. If I start just focusing on these tiny details, it will take too much time, but think about what is highlighted with green. Why do we have this term here? So we can make some details. That's gamma for foreign exchange options. That's delta for stock options. So it can just add it into a put call parity, and you can link that carry benefits with interest rates. So the same way we can have the same present value of the expected future cash flows, what we have discussed several slides ago. This is the expected payoff of a call option, expected payoff of put option. So we have new stock components for these instruments. So the general approach remains basically the same. So just one term is adjusted. If we talk about the dividend paying stock, the dividends influence the dynamically managed portfolio by lowering the number of shares to buy for calls and lowering the number of shares to short, sell for puts. Because if you are able to receive the benefits of dividend payments when long the stock, you're unable to receive these benefits when you're long a call option. At the same time, you have to pay dividends when you short the stock, but you don't have to pay dividends. I mean, the price, you have to pay dividends. It means that the price of a stock is adjusted for dividends. So you don't have to pay dividends when you have a call or put option. So this is the same thing. You have to look carefully for these statements and think in details about how dividends affect the call price. So if I have a call option, I don't have any right to receive a dividend. I can just say that the stock price changed, and that's why the call option price changed. The market can expect dividends and so on. But I don't deal with dividends directly. The same thing for puts. So as for currency options, so we now just move from one type of product to another one type of product. So we talk about the currency options. The line instrument is the foreign exchange spot rates. So in fact, the concept is analogous to the number of shares of stock covered in an option contract, the units of foreign currency. So an overall cost of the option is obtained by multiplying the formula value by the notional amount. The formula of the Black-Scholes value, the notional amount is the currency amount. So we treat units of foreign currency the same way as we treat shares. Like 1 unit of foreign currency is a share that can generate that brings me a certain profit. That's the approach. So this is a more detailed explanation. So here is the foreign exchange stock component, and this is the buy component. Here we can see the call options. We have the same adjustment for put options. Here is the stock component adjusted for the foreign risk-free rate. And this is the bond component. The bond component is not adjusted because I operate in my local currency, and my local currency is currency, while the foreign currency is a stock that I purchase for units of my local currency. That's the general approach. So we're now going to focus on some details. I just talk about some basic things, and I do believe if you start dealing with options in details, you're gonna read specific chapters in how or Beck. Carrie Beck is a nice book on derivatives. So, and I think I would share this book with the group because it's really a nice one. So I highlight basic topics like our lectures. If we talk about a derivatives job, is a list of things you'd better know in details. Since I'm not sure if all of you are deeply in derivatives, so I can just highlight basic topics. So what's next? Several years later, after the Black-Scholes model was introduced, in 1976, Fisher-Black introduced a modified version of the model, and a new version was applicable and is now applicable to options on online instruments that are costless to carry, such as options on futures contracts, equity index futures, and options on forward contracts. So here is my favorite topic: options on futures on index. For example, options on VIX futures. So VIX is a volatility index. It has an economic sense, but it's very difficult to build a bridge between support and demand, or fiscal and monetary policy, the classical milestones of economy, and a volatility index that is a derivative of an S&P index. So it is not that straightforward. And if we talk about options on futures contracts, on the second derivative, on a broad index, that's amazing. The economic sense is so difficult to find out that we can mostly treat it as a random process. I mean, if you're good at economics, it's a good idea to study macroeconomics, parameters, inflation, and green function, and so on, and trade commodities and or currencies or something. If you are not good at macro analysis, if you are not good at analyzing financial statements, if you are more into math and finance, I mean, detail, structure of finance, these details, it might be better to focus on more abstract things. So I do believe that the instrument and the subject should be of the same nature. So if I apply math, if I apply modeling, it would be better to apply this approach to something that is closer to an abstract notion. So I mean that production cycle is something that more deterministic, and it's not a good idea to apply these stochastic processes to a stock of a production company or to any commodity. That it's not a good idea. You have to adjust it for production cycle. If you don't adjust it, you will get a fake model. It won't work. But if we talk about abstract things like index on index and so on, these fifth order derivatives, they just lose their economic sense and can be perfectly modeled with math and these approaches. So that's my personal opinion. And it's not like a part of a lecture, it's just a personal opinion. Mostly derivatives books don't offer you don't advise you any strategy. So what do we have here? Formulas. What do we have here in these formulas? F, that's a futures price. This is a stock price, this is a futures price. That's really, I do believe that it's quite easy. So we just manipulate with the futures price. It's important that everything we talk about is assumed to be a European style. As for American options, we have a different approach, and it's really another level of pricing. So we always talk about European options, and the Black-Scholes model is applicable to European options. But what is important? So what we've got here, the same thing. We had a stock component and a bond component. Here we've got futures component and bond component. That's very similar to what we have discussed before. So we can evaluate futures or forward options, OTC options on forward contracts or exchange traded options on futures contracts. So we have to compute the present value of the difference between the futures price and the exercise price. That's very simple. Another slide is dedicated to interest rate options. While futures options is something that's used by structurers and speculators, then interest rate options is the core banking. The core banking business is distributed liquidity and mitigating risks. So purchasing money for interest rate and lending money for another interest rate is the core banking business. And that's why interest rate options are critically important for hedging any corporate bank, any retail bank. So interest rate options are really important. So how do we treat interest rate options? Interest rate call gains when the reference interest rate rises. Interest rate put gains when the reference interest rate falls. We use interest rate options to build structured products. We use interest rate options to build credit-linked notes. So they're widely used. They are traded. Interest rate options on futures, on rates are traded. And there might be OTC interest rate options as well, issued by investment banks. So as an example, we can consider an interest rate call option on 3-month LIBOR with 1 year to expiration. In this case, the underlying interest rate is a forward rate agreement, FRA, that expires in 1 year. So this FRA is observed today, and it's the online rate used in the Black model. So this is what is used in an underlying rate. And the underlying rate of the FRA is a 3-month LIBOR deposit that is investable in 12 months. It matures in 15 months. Thus, in 1 year, the FRA rate typically converges to 3-month spot LIBOR. I do understand that this example sounds a little bit sophisticated. In fact, it is not. So just make a note that you have to read carefully these interest rate things. They just seem to be difficult, but in fact, they're not. So first of all, I have another slide dedicated to the same topic. So if we talk about an FRA contract, long an interest rate call option, and short an interest rate put option, allows us to generate a synthetic, receive floating, pay fixed FRA, and an opposite contract when we receive fixed and pay floating can be generated, can be produced by long put and short call. We also have what is called a cap and what is called a floor. So interest rate cap is interest rate cap is a product where you cap in interest rate. There is a certain ceiling for an interest rate, and it can be regarded as a set of floating rate loan payments. So we use interest rate cap to cap floating rate payments. The same thing for interest rate floor. This is an option with a set with a floor with a minimum value. So it locks the minimum value. These products are often used in jointly with credits. They're embedded into credits, and that's why they're not like a single option. They are a series of options. So there is another explanation for interest rate options, and I'd like to show you. That's the same thing. Some real world use cases. So when we talk about interest rate options, about caps, so cap is often linked to credit. If we talk about credit pays, or credit is an obligation, it is an asset or liability, and payments are made according to a schedule, like monthly. So every month there should be a payment. So if I'd like to cap, or if I'd like to lock an upper limit, or if I'd like to lock a lower limit, I have to issue a series of options with expiration date equals to interest payment date. And these options that are parts of the same product are called caplets. If we talk about locking the upper boundary, or floorlets if we're talking about locking the lower boundary. So what about real world use cases? I've got some examples. You will have a look at these examples in details at home. So in fact, the general part of the lecture, I mean the core things that requires my assistance are over. So I mean, if you're in a hurry, if you'd like to take a breakfast or something, I won't go to any formulas or something. I will just in broadcasting mode, I will tell you some stories like from derivatives world. So man, if you'd like to, you can stay tuned in. If you like to do whatever you'd like to do, you can just tune out. So what about interest rate options? What about interest rate caps? It is used as an insurance for corporations that borrows float rate. Banks are willing to lend floating rate because they don't have any corporate credit as a credit that's issued for like 20 years or 15 or 30. Banks has no source of funding to fix an interest rate for 30 years. That's really difficult. So they have to borrow floating and issue credits. And they prefer to issue floating credits as well. However, corporates would like to have fixed rate credits. So banks would like to transfer an interest rate risk to a borrower. And if a borrower would like to protect himself against a sharp increase in the reference rate, it can agree an interest cap, like a selling rate agreement. So the SEC, the US Securities and Exchange Commission call this agreement a selling rate agreement. It's an amendment to a loan agreement. You can Google these loan agreements at the SEC website. Details, sell rate agreement, everything. So the first use of interest rate options is an insurance for corporations against a sharp increase in reference rate. On the other hand, banks would like to hedge themselves against a sharp decrease in an interest rate, and they can agree a minimum interest rate with a corporate borrower. And these agreements is known as a floor provision. So it's an interest rate floor. And in some countries, interest rate cap similar provisions exist to regulate the lending market, for example, in Portugal. So they just on a country level, they cap a maximum interest rate. So if you price any loan for a bank in Portugal, you have to bear in mind that it's really difficult to predict the cap that will be issued by a regulator. So every quarter, a new cap is issued. So this quarter, a cap is like 5%. What about the next quarter? Will the cap be 5% or 6% or 4%? So there's an additional task for quants to model the Portugal bank cap rate. Interest rate options can be used for creating synthetic swaps, synthetic FRAs, synthetic RFA. So you can just draw interest rate payoffs, and you will see that like long cap and short floor replicate a swap fixed leg, and the opposite position will be a floating leg. So you just need a pen and a paper and draw the payoffs, and you will see that these instruments can replicate any interest rate product. So there is a product that's called swaption. This is an option to enter a swap. We won't focus on this product, so this info about swaptions is given like additional info. It's a bit outside the course. It's a very complex product, so I just keep this here. We've got look-back options and a wide class of path-dependent options. It's out of the scope of this course, but as the market today is full of various structured products, I just wanted to add a bit. A path-dependent option is an option that has to remember its value at a previous time. So while we were talking about a stock, and the stock in our model does not remember itself, Here we've got the stock that has to remember itself. But it's really interesting that, in fact, these path-dependent options can be priced with the use of the Black-Scholes. However, this path dependency feature is really difficult to introduce. And we have like, I don't illustrate these examples with formulas because one formula is approximately 2 lines. So I think that it's too much introducing you slides with full of formulas without providing a proper explanation. So just believe me, that formulas are great. They help us, but they're huge as well. So we have a look back call. It allows the holder to purchase the end line at the lowest price achieved during the look back period. And we have a look back put that allows to sell at the highest price. These options are really nice. They offer us a high level of customization and risk reduction, and they are very pricey. And that's why the market for these options is not a developed one. It's not an active one. This is a very custom product and very expensive. So an issuer of a look back call or an issuer of a look back put need to predict the behavior on assets for a certain period and to price the product to ensure that this is a valuable product for an issuer, and at the same time the price should remain low to make the product attractive. So in fact, this type of look back options is not a very popular one. At the same time, there are various types of look back options. You can have a fixed strike or a predefined strike, where you have a floating strike that's chosen as the lowest underlying price during the term of the option. That's mostly the we at the settlement date, we look back at the period and we find the lowest underlying price during the term and make it our strike. But the purchase price is our current price. So if an instrument lowest price was 10 and my today's price is, and therefore today's price is like 11. So the payoff is 11 minus 10. If the maximum price of the look back period is 10 and today's price is 11, so the payoff is 1. In this case, we have a fixed strike, but we calculate the difference between the strike. So we have a strike, and here we've got our today's value. So this is the difference, today's value and the maximum absorbed, and here is the strike and the maximum absorbed. That's the difference. So lookbacks were first used in 1982. They were just a simple way of purchasing gold at lowest price. And they was quite and they looked like a normal instrument, a simple one. But today, these instruments are loved by structurers, and they include these instruments into some products like Phoenix. So instruments look back at performance of a basket of equities or indices and pays coupon if the price of the worst performing asset during the look back period is not lower open threshold level. So these products are really complex. And even in our country, I mean, in Russia, these products, there was an attempt to sell these products to unqualified investors. I see lots of such attempts to sell these products to unqualified investors. So for now, it is somehow prohibited as well. But let's have a look. I mean, this product is complex. And even to professionals who are involved in pricing, it's really difficult to price this product, to predict this product. While at the same time, how can investors like lawyers or top singers or teachers, how can they predict a payoff of this product? And probably that's a good idea to restrict sales of these products, because sometimes they are sold as bonds. Just imagine, I have talked about this during our course on ethics and professional standards. These products cannot be sold as bonds. They can be sold, okay, but they're not bonds. They're not bond-like. So, and sometimes that's very often to combine the look-back feature with a barrier feature. The barrier sets up a percent of a price decrease or a price increase, most common a price decrease. So first, we track a basket of equities. We fix the worst performer, and we compare the performer's price with a barrier for worst performer's price. So these two features can be combined in one structured product. It's a very famous combination, very popular, beloved by various Russian companies, as well as by Natixis and by Leonteq. These companies produce these products abroad. And the final type of options that we'll discuss today in a radio broadcasting format are barrier options. So in its simplest way, there is an underlying, we track underlying price, and we set a barrier. If an underlying price is lower than barrier, the option, so there are variants. So I have an asset and I have a barrier. They might be down and in. The option is inactive. If the price goes down and breaks the barrier, the option turns in. Down and out, the option is active. The price goes, if the price goes down and breaks the barrier, the option is out. I mean, it expires, no money, nothing. Up and in, the same thing. Inactive option, barrier, if the price goes up, it activates the option. Up and out, the same thing. Active option, price goes up, breaks the barrier, option is expired, no money, no payment. So this out feature is beloved by structurers as well. You take an asset, you track its price, you predict the price will change its movement or the price will break the barrier. You introduce a structured product with an out feature, knockout feature. You wait till the asset breaks the barrier, and you just enjoy the premium because the option expires. So your obligation vanishes. A perfect feature. And that's why these barrier options in real world use case leads to fines. So once Berkeley's were fined for £284 million for market manipulation. So they try to manipulate gold fixings and FX fixings in order to avoid payments, and they were fined for market manipulation. Just imagine, nearly 300 million pounds. So the final is a compound option, an option on an option, a very rare case. So what's the rest? You will see a lot of questions in the quiz, but they are mostly about calculating. And I will share a Python example, or you can use an Excel. So our derivatives radio broadcasting is over for now. So as for those of your friends who had to leave, I will email this presentation today. So you can have a look. You can ask some questions about products. I can provide you with links on these agreements, supporting documents on everything. So if you're interested in details. So if you don't have any questions, and I hope you don't, have a nice weekend. And next Saturday gonna be our last lecture. It has some free time. So, and I hope we will talk about some derivative crises. So many thanks. Have the best weekend.